Ever wondered how to invest in a smart way without having to sift through mountains of paperwork to understand individual companies and markets? Well, that's where funds come in. Today, we're breaking down the world of fund investing, how it works, and which options you have. Let's dive right in. Think of a fund like a basket of investments. Instead of putting all your money in one stock, you invest in a collection of stocks, or bonds, or commodities, you name it. Let's have a look at the well-known MSCI World Index Fund as an example. Putting $1,000 into an MSCI World Index Fund is designed to replicate the performance of the MSCI World Index overall. The fund manager uses your $1,000 along with money from other investors to buy a representative sample of stocks from this index. The fund manager ensures that the weights of each stock in the fund are similar to their weights in the overall index, which also means that the fund will have a similar sector and geographic breakdown to that index. The fund manager continuously monitors the situation and makes adjustments to the fund holdings as needed to ensure it remains aligned with the overall index. Having a fund like this can be a great option for many investors and for many different reasons. They help you diversify by spreading your money across multiple assets, reducing risk, but crucially, they also help you manage your emotions. Many investors try to time the market but often fail to do so. But certain funds are run electronically by algorithms that track the movement of the markets, and we'll talk about that in more detail later. But best of all, funds are easy to access. You don't need a finance degree to start investing. But of course, investing, even if it is in funds, isn't all sunshine and profits. Before you invest, make sure you understand the fee structure. That's how much you pay for accessing and holding a fund. You should expect to pay for the management of a fund, but some funds have high management costs that can eat into your returns. You should also understand that even diversified funds are impacted by market risks, and not all funds let you cash out instantly, as we'll discuss. So make sure you also have a diverse series of fund options that can help you manage these challenges. Let's take a look at the three key types of funds in more detail. First up is the traditional or mutual fund. A mutual fund pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets, just like in our earlier example. Traditional funds tend to be long-only funds, so you buy it and hold it for a longer period of time. But even in the more traditional side of the fund universe, there is a huge amount of choice out there. For example, in equities, there are different sectors and regions. With bonds, there are corporate debt, there is government debt. And with both, you can look at developed or developing markets. You can even mix and match them to your preferences. Crucially, however, you can only buy or sell at the day's closing price, not in real time. And this is very important because it differentiates traditional funds from exchange-traded funds, or ETFs. ETFs are similar to traditional funds, but trade like stocks on an exchange. Most ETFs are passively managed, tracking an index like the S&P 500, NASDAQ, or the MSCI, as we mentioned before. But some are more actively managed, and you can buy and sell ETFs at any time during the trading day. This is known as intraday trading, just like stocks, which can be very important for some investors. Finally, a very important asset class, hedge funds. These are private investment funds that use advanced strategies, short selling, leverage, derivatives, and alternative assets to try to generate high returns. They're usually only interesting for more sophisticated investors who have knowledge and experience in the field. Because they are subject to fewer regulations, investors need to do their own due diligence or work with managers who do that for them. Unlike mutual funds and ETFs, hedge funds often have lock-up periods, meaning investors may have to wait months or even years to withdraw their funds. However, they work very well combined with more traditional fund strategies in building a portfolio. And if that is all still too much deciding for you, a fund of funds is a fund that invests in other funds. Mostly these are hedge funds or other alternative investments, but they cover the traditional ground too. It's like a super layered investment cake, offering extra diversification both in strategy and managers. And even though it sometimes comes with higher fees, it can be a very tasty option, especially when it comes to private markets. One of the key advantages of funds is that you can achieve a diversified approach while focusing on what matters to you most. Thematic investing focuses on big trends like clean energy, AI, or healthcare, and at Julius Baer we call these our next generation topics. You can diversify further by focusing on demographic and social trends like longevity-related industries or geopolitical and policy-driven themes like infrastructure, for example. When it comes to thematic investing, however, you have to carefully weigh them as part of an overall portfolio. As a general rule, one should allocate around 5% to thematic investments to maintain diversification. So whether you're new to investing or looking to step up your game, funds can offer a smart, diversified way to grow your wealth. But don't forget that they are also subject to the ups and downs of the financial markets and should be used as part of a balanced portfolio strategy aligned with your investment objectives, risk appetite, and time horizon. Check out Julius Baer's How to Invest series on YouTube for more insights like this. And don't forget to like and subscribe so you don't miss an episode.